In recent weeks, the American financial landscape has been roiled by a downturn so pronounced that analysts are drawing direct parallels to the darkest days of the Great Depression. What began as a series of tariffs intended to recalibrate global trade relations has now triggered market plunges, rivaling the upheavals wrought by the COVID-19 pandemic and the 2008 housing collapse. This report examines the data, the decision makers, and the unfulfilled promises that have converged to produce one of the most turbulent opening chapters of any modern presidency. The slide in market indices is stark. As April draws to a close, the Dow Jones Industrial Average is poised for its worst monthly performance since 1932, a year that saw the economy collapse into total crisis. Four-way crisis. Investors have witnessed precipitous declines and sharp volatility spikes, with daily swings reminiscent of the panic-driven sell-offs of past eras. These patterns are not anecdotal. They stem from month-over-month calculations that place today's downturn squarely alongside the 1930s most harrowing financial moments. President Trump's first 63 trading days in office have yielded especially concerning figures. The S&P 500 has tumbled 14% since his inauguration, marking the worst such decline to start a presidential term since the index began tracking in 1928. The Dow itself plunged by 11% in the same period, before clawing back marginally. A roller coaster trajectory that underscores deep unease among institutional and individual investors alike. Adding to the alarm, the International Monetary Fund's chief economist recently warned of a 40% probability that the United States could slip into recession on account of the administration's tariff campaign. Such a forecast from an organization tasked with overseeing global economic stability has intensified scrutiny of Washington's trade strategy and raised the specter of more pronounced job losses, lower consumer spending, and broader credit contractions. At the heart of this economic maelstrom lies a widening rift between the White House and the Federal Reserve. President Trump has publicly lambasted Fed Chair Jay Powell, accusing him of insufficiently supporting the administration's approach. The Fed, for its part, has been candid in its assessments, assigning low marks to the tariff regime's capacity to bolster long-term growth. This escalating clash has eroded confidence in the Fed fears of political interference in monetary policy. As market pressures mount, the administration has sought to redirect blame toward Jay Powell. Presidential statements, emphasizing the revenue we're making so much money from tariffs, stand in stark contrast to the market's reaction, characterized by stagnation and apprehension. And rather than offering concrete reassurances, these remarks have only underscored the growing disconnect between official rhetoric and financial reality. On Wall Street, the reaction has shifted from analytical to near prayerful. Headlines in leading outlets such as Bloomberg and Yahoo Finance now center on hope that the trade war will abate, hope that China will agree to concessions, hope that new threats will be shelved, hope that the administration will reverse course. This reliance on optimism over hard data reveals the depth of traders' desperation. Careers and commissions hinge on the smallest uptick in policy clarity. Conspicuously absent from the conversation, however, are the trade deals that were promised in profusion. In the 9 days following vows by the president's chief trade advisor to secure 90 deals in 90 days, not a single agreement materialized. The tally remains at zero, even as markets have digested the loss of trillions in value, and the proclamation that such chaos was ultimately in service of bilateral breakthroughs. Faced with these dismal economics, the White House has mounted a messaging pivot. Staffing briefings now focus on immigration enforcement, the Greenland affair, and other high-impact headlines designed to distract from the tariff fallout. Yet this scattershot PR approach, replete with off-the-cuff remarks and shifting talking points, risks compounding public skepticism rather than restoring confidence in governance. In the midst of this confusion, business commentator Grant Cardone stepped forward with a stark admonition for everyday Americans. A step aside. stay out of the game. We're dressing retirees fretting over their 401k, accounts and bankers eyeing commission losses. Cardone claimed that only President Trump holds the playbook for navigating the crisis. And implicit in this advice is a disconcerting message. Individuals should relinquish control of their financial futures to a government whose own policies have precipitated the current slump. The broader implications for the American public are profound. Households, pensioners, and small investors cannot assume that federal policies will shield them from market gyrations or deliver windfall returns. The sustained absence of consistent trade agreements, coupled with public spats among top economic stewards, leaves individuals to shoulder the burden of policy volatility. In conclusion, the convergence of uncompleted trade promises, escalating Fed White House tensions, and data-driven market declines paints a sobering picture. President Trump's tariff strategy, initially touted as a bold means to recalibrate America's global position, has instead ushered in an era of heightened risk, reminiscent of the Depression-era trough. Without tangible agreements, clear policy direction, and restored trust in America's economic leadership, the current slump threatens to deepen. And so too does the real possibility of a downturn that endures far beyond the next quarter. The protracted tariff standoff has begun to ripple unevenly across key sectors of the economy. In manufacturing hubs from the Midwest to the Southeast, factories report both rising input cost and diminished orders as overseas buyers delay purchases amid uncertainty. Farm states likewise face mounting pressure. American exporters, once buoyed by competitive commodity prices, now find their goods undercut by retaliatory levies abroad, squeezing margins for soy and pork producers already contending with volatile weather and rising fertilizer costs. Technology firms, heavily reliant on complex global supply chains, are forced to reroute components or absorb steep tariff expenses. Moves that ultimately threaten to slow investment in research and development and undermine the sector's contribution to growth. Currency markets have sensed the turbulence as well. The dollar strengthened initially on safe haven flows, only to relinquish ground as investors question the sustainability of US fiscal and trade positions. DCs. Emerging market currencies, battered by capital flight, highlight the interconnected nature of today's financial system. A policy misstep in Washington can reverberate from Jakarta's bond markets to Sao Paulo's equity exchange, constraining global credit and potentially triggering broader retrenchment. Against this backdrop, leading economists advocate a recalibrated approach. They urge targeted tariff relief for strategic supply chain bottlenecks, particularly in semiconductors and agricultural inputs, coupled with intensified negotiations aimed at securing enforceable commitments rather than broad, punitive measures. Bipartisan oversight in Congress may serve as a stabilizing force, ensuring that any adjustments align with national interests and long-term competitiveness, rather than short-term political objectives. Investors and policymakers will closely monitor several impending milestones: upcoming GDP and personal consumption data, the Federal Reserve's policy statement following its next meeting, and the Treasury's debt issuance calendar. Congressional hearings on trade impacts may further illuminate hidden spillovers and shape legislative remedies. Meanwhile, market-based indicators such as the yield curve, which has flirted with inversion, and the Chicago Fed's leading economic index remain critical barometers of recessionary risk. Ultimately, the stakes are profound. Without a coherent, transparent path forward, one that balances strategic trade objectives with the imperative of market stability, America risks entrenching the very downturn it sought to avoid. The coming weeks will reveal whether policymakers can translate hope into tangible progress, or whether the economy will be left grappling with the fallout of an unresolved trade gamble for months, if not years, to come.